We're going to talk about financials. You want to have worked on this long before you're getting ready to go pitch for money. This is fundamental to the way the business works. So, Sharice, let's see, what did you do with
Oh, I'm sorry. It would be helpful if
Yeah, I'm going to need that
I left this for
push
you.
button thing. So, talking about the financials, so how many of you love to work in Excel? Just love to work in Excel. Anybody? I'm serious. Anybody love it? Yeah? Yeah? Okay, you're the scary ones. Your models are going to have 84 tabs. There's going to be 84 worksheets. And it's not going to make sense to anybody but you. Okay? So no matter how many background tabs and hidden tabs you want to do and all that stuff, whatever, when you're building a model that you're going to, at some point in due diligence, you're going to have to share, right? I mean, not only do they want to see your PDFs, but later, they're going to audit your model to make sure the numbers add up. Okay, math errors happen. So keep it really simple. 6 tabs that Sharice calls out here, and I agree with this. We've been going back and forth. It's interesting. I do a lot of financial modeling for Midwest companies. She's done a lot of it on the coast. We had different views to it. It was really very interesting to go through resolving some of that together. And there's no one way to do it. But annual profit and loss by month. Absolutely have to have it. Don't show me yearly only numbers. I'm not going to buy it. It is the monthly P&L is critical every month. Monthly revenue projections by month and how you got there. Not a number. How did you get there? I'm going to ask you. Again, I'm talking to you as an investor, and I'm going to ask you how you did that. Monthly expense projections. And we'll get into some of how you can break that down. Team projections. Who and when. How much? How much are you paying them? And this is primarily people are coming on your team. The outside contractors you're going to handle as a separate expense. Most importantly of all, cash flow, cash flow, cash flow. If you've heard, there's only 3 things you need to know about real estate: location, location, location. Please apply cash flow to the financial world of startups, because I don't care about your balance sheet. It's probably fictitious anyway in a lot of sense of a software company. It doesn't have a lot of assets. It's an actual discussion in the world of finance right now is how do banks survive in a world of non-physical assets? Because banks, they lend on asset base. And we have companies now with 25 employees throwing off hundreds of millions of dollars a year in revenue. Right? They don't have any assets. So are they just not lendable? So it's an interesting question. So have all this prepared. Don't go through it in the first meeting. Do not drag somebody through your financials. I don't want to see them. If I haven't even figured out if I want to talk to you about an investment, I really don't want to see your financials. Having said that, a nice tight summary of what the next 3 years look like. Top line, what's your revenue, what are your expenses, what's your operating profit. That's okay. If you want to put that in there, fine. But don't go any deeper than that. No more than 3 or 4 total lines. In presentation, there's a guy named Guy Kawasaki who was the first product manager at Apple. He launched the Macintosh, the original box. And he's a very well-known angel investor, and he has something called the 10-20-30 rule. I'm not making this up. He published it in one of his books. 10 slides, 20 minutes, 30-point fonts. 30-point fonts. Because if you're in the back where David is, and you're trying to read that screen, if I can't read your slides, do you want to know how upset I am with you right now? You took my time, you got me in a room, and I can't read anything. So keep that all in mind. Simple, simple, simple. So on your forecast, you've got to develop a realistic forecast, and it's got to be detailed. Do not gloss over your numbers. One of the very first things I'm going to do to validate somebody once I've actually sat down, let's say I listen to your pitch, and I say, yeah, I want to take a look at it. I'm going to have you send me some summary financials and maybe your business or marketing plan, whatever you happen to have. And the first thing I'm going to do is tie the two together. I'm going to read your plan and look at the financials and say, well, she said she's going to do a trade show twice a year in California. I look over your expenses, no money. Okay? That's talking to me about what kind of business manager you are. So you've got to have these things add up. It's very, very critical, and it's a quick way to get rid of an investor. Is when your financials don't work out, we're done. We're not going to trust you with our money. That's what it comes down to. Financial models, we all know they're wrong. Okay, everybody that's ever invested at angel level knows the financials are wrong. Okay, we know you don't know for sure. We're trying to figure out what are your assumptions. And the model you're going to see in a little bit is something I will make available for free to any of you. It's rooted in assumptions. All the assumptions literally are in yellow in the spreadsheet. Okay, there's a reason for that. What are you assuming for the cost of credit card services, the cost of interest, the salary of this person, et cetera? Because those are all assumptions, and you will learn over time. But the point is, we're going to be looking for what assumptions you made. Make them very, very clear. First 12 to 18 months are the critical numbers. We all know that 24 months out, if you hit a home run like Airbnb did, yes, we're going to throw your plan away and start over, and we're going to enjoy it very much, right? Nobody's going to hold you accountable for that. And if things didn't work out, you'll have to update the plan, and you'll probably change the way you're spending money. You'll probably do some things differently. So don't get that worried about year 3. 3 years is normally enough. I have read several good blogs. Fred Wilson had one the other day, quite a while back, about why he asked for 5 years of financials. He says it this way: the first 3 years are supposed to be somewhat close to what you really think will happen. The 5th year tells me what you aspire to. What do you aspire to? Is this $1 billion business? Is it a $100 million business? What is it? And you may say year 4 is an exit, and I'm done. That's my plan. My plan is to exit in year 4. And by the way, that's not a bad answer. In a lot of vertical market software, it's the best way to go. And in fact, in some product companies like Kip, like your product, if somebody would walk in and write you a very, very large check with royalties on the back end for what you have and take it global, you'd probably be happy to say, go for it, right? So you may not have a 5-year plan in that sense, but if you're really going to build the company, if you're going to build the next Airbnb, if you're going to build the best real estate platform in the world, what do you aspire to? And that's where that 5-year number comes from.
So, Mike, do you want a 5-year projection, or do you want to stop at 3?
I stop at 3. If somebody asks you for 5, I just want you to understand where it comes from. I don't recommend it. Now, for those of you who are operating a business, like the model I use is a 5-year model, sometimes what you want to do, because a lot of times you're going to be in the middle of the year, right? It's March. It's not January 1. And so sometimes what you want to do is load up your actuals from last year so that you can show it as actuals last year and then current year, year to date, and current year, future years. So sometimes your model needs to support 4 years simply so you can show what last year did. But 3 years should be enough for most people. All right, so when we're talking about assumption, when you're doing this on revenue, number of units sold times price. Whether you're selling by the contract, I've got a client I work with whose average contract size is $10,000. She's forecasting each contract. She's forecasting what the name is, literally, who's next, all right? If it's selling unit sales, Latha, if you're going to a trade show, what's your forecast for what are you going to sell? I mean, you should have an idea of, I'm going to come out of there with 10 leads and 2 deals. It's not, I'm going to sell 10 the first month and 10 a month every month thereafter. Those are the business models that get tossed in the wastebasket. Okay, flatline numbers. And I'll tell you this about everything, about your expense forecasts, about your revenue forecasts. If it's the same number year over year, every month, same number, I don't buy it. I have never seen anything not change in price for 3 years, right? If you're tripling the number of people and the expense for your rent stays the same and you don't buy any furniture, what am I supposed to think? Did you think it through? So, number of units, expected reoccurrence on SaaS models, software as a service, any kind of reoccurring revenue models, the renewal rate, reoccurrence rate, how many renew each time it comes up. So if you've got 100 customers that pay yearly, how many are going to renew next year? It's not 100%. Now you may not know, but this is an assumption you're going to have to draw. If you're in a SaaS-based business environment in a vertical market, you can get good data. On Crunchbase and other places, you can find out good data. What's the average reoccurrence rate for that market? But the truth is somebody's going to fall out and you need to plan for that. Ideally, long-term, you can tie the revenue assumptions to sales and marketing drivers. If you know what your CAC is, your customer acquisition cost is, if you're doing marketing on Facebook right now and you know $100 of ads gets you 4 customers to purchase on the website, you can draw the obvious conclusion that I can amp my spend up. If you're on a national model, I can amp up my spend and I'll see that track. So that's where you want to be a little later stage. Early stage, it's going to be much more about, if it's consumer side, you're going to be estimating based on how big a reach you have. If it's B2B side, business to business, you're going to estimate, I'm thinking about the system you have for cleaning, for the cleaning environments. You're going to estimate how many people you can reach with the sales people you have. What's the sell cycle from first visit to a customer to check in hand? I have money. How long is that? And that's probably one of the most important things for you to know if you're in the business to business world is what's your sell cycle from first contact, Tom and I meet in a trade show booth, to Tom actually sent me money. What's that distance? Because if it's 3 months, that's a very, very different model than if it's one of my clients, it's 15 months. The amount of cash they have to have on hand to live through 15 months is much higher. Revenue sources, there's a lot of different kinds of revenue, and this is where your model will vary a lot. I do a lot of models for people, and it's part of what I do for free, so I'm happy to do this as part of the work I do at the partnership for any of you. Every revenue model looks different. There are some basics, templates I have that you can start with, but everybody's revenue model is a little unique. I will tell you to try to keep it as simple as you possibly can, because when someone like, let's say Joe Leo was trying to look at it as an investor, the more complex your model, the harder you're making it on the investor. So try to keep it fairly straightforward. We understand there's exceptions to the rule. We're not worried about the 3% exception. We're worried about the 90% on average. Because again, we know it's not going to be exactly right. So the price you charge, how often it reoccurs, if it's a software, any commission you pay, any revenue share you have to give up, credit card fees, and then what's the volume. And in a lot of the models, you can do that very, very easily. There's a lot of other types of revenues in there. There may be installation fees if it's a hardware. There may be setup fees. It's really common in vertical market software to have to do setup, to get them on. They call it onboarding a lot of times. People will pay for that. It's good money. In fact, it's a nice way to fund a position in your company is simply charge $495 onboarding fee. In a lot of cases, onboarding might be only 2 or 3 hours, and you get $500 for it. You can fund a customer support person for that, right? Expense forecasts. This is something Sharice brought to my attention I did not know about. On the coast, and in the larger VCs, they want to see it broken out by area. And I think it's absolutely brilliant to do it that way. Most corporations would make you break your expenses out this way, but they're reporting into their P&L not only the cost of revenue, but the development separately, a separate section for what does it cost to develop and maintain my product. Hardware or software, what's that cost over time? Then sales and marketing. What are your sales and marketing costs? Separate. And then what are the operating costs of the company? Because as someone that looks at businesses, you really need to know what what's the percentage of revenue you're spending on sales. What's sales and marketing costing you? And when somebody says, what's your CAC, what's your customer acquisition cost, it's this area, sales and marketing. That's the area. So calculating, if you can look at your sales and marketing budget for a year and it's $350,000 and you're planning on selling 13 customers with that, or 10 customers, it's $35,000 a customer. That's your CAC. I hope you make more than $35,000 on it. That's a really important thing to know. And obviously year one, when you're not breaking even yet, it's going to be way higher than you want it to be. It will grow it will shrink over time, but that's one of the things we're looking at is by year 2 or year 3, what's your customer acquisition costs look like? The last point, know your gross margin. This is absolutely critical that you understand. There's a lot of people that just don't understand, and don't feel bad if you don't, but the reality is if you sell a product for $100 and you paid $50 to get it to the market, you only have $50, not $100. And that 50 is what you have to run the entire company on, and that's all you have to spend on people, new product development, everything. So that gross margin, how much you make per sale, is huge. It's one of the first questions I'm going to ask you. If you're in the hardware business, Amos, what's your gross margin? Right? I need to know that right away. If it's 18%, I'm going to run away. Now, there are businesses that 18% gross margins work really well, but I'm hoping it's over 50, 60%, especially if he's got to sell it through a channel where he's going to give up something. So knowing that gross margin is absolutely critical. Team forecast. And I'm not going to have time to go into the spreadsheets today, I don't think. In fact, I don't think there's a way to hook it up over here. in the spreadsheet, you enter these by tab. So there's actually a team tab that includes the salary of each person, what month and year they come to work, what's their position, how much they make, what are you going to give them for a raise? You're not going to keep people if you don't give them a raise. So all these things have to be calculated in. So a lot of the model templates that you can pick up online, or the one I have, you just enter all these things. You enter and say, John Smith starts in 6 of 2018 for $45,000 a year, and I'm going to give him a 3% raise on average. I'm going to plan on a 3% raise. That's what I'm going to do. Cash flow. I cannot express enough how much this means to me. If you don't know your cash flow in detail, down to the dollar, damn near, I'm worried about you as an operator. What if you, for first-time entrepreneurs, how many of you, don't feel like you have to raise your hands, but how many of you have a net worth statement done? You know exactly how much you are worth, how much is in every account, where it's at, and when the last time you did check the balance. If you don't live that way in your own life, you have an uphill battle, because that's the way you have to live your business life. You have to know all these things all the time. So when you start talking to investors, if you don't have your cash flow in your brain, if you don't know exactly what your burn rate is, okay, and you're going to hear this term, burn rate. What's your burn rate? What's your burn? There's a guy I knew who was just a real arrogant pain in the butt that used to come to some of our angel meetings. I actually asked him to stop coming in, because he'd walk up to you, he wouldn't even say hi to you. He'd go, what's your burn? It's rude, but the point is how much cash are you burning every month running your company? How much cash flow goes out that isn't coming back in? And all startups that I know of have a period of time, sometimes years, where there's more cash going out than there is coming in. So don't be embarrassed about it. But if your monthly burn's 20 grand, that tells me a whole lot about what you need, where you need to be, how much money you may need to raise. All of those things are going to come home through
Mike,
that.
Can I ask
Yeah.
a question about that?
Yeah,
For a startup that maybe has only 90 days of reserves,
right.
any advice on how to explain that, talk about it, position it in a way that doesn't freak out the angel investor to say, we can't move fast enough, you're going to be dead before I can help you?
Sure, because a lot of angels, if you only have 90 days and you're compelling, very compelling, they'll do a quick note. If I called Joe up, the attorney over here sitting in the back, said, Joe, I absolutely love what Amos is doing. He's flat out broke. I got 5 investors. We're all going to put $5K in, and we're going to do a $25K note on a safe form or whatever you think, Joe. How long would that take me to get?
An hour.
An hour or two?
$50.
So if I'm serious, I think you're great, then it's an hour of lawyer time, and 3 days later we can have them signed. It'll probably take longer to get the checks together. So there's a way. And that would bridge him long enough, we would hope, and that would be enough, we'd figure, to go through the 90 days it would take to do my due diligence and really think it through. And yeah, I'm making a bet. And if Randy's one of the guys, and he and I did this together, and we don't make a further investor, we're all out 5K. We just threw 25K on the ground to go shopping. So it's a little harder, but you know, if we believe in it, it's worth it. So spend wisely. I had an entrepreneur I was working with for a while that was having some problems with cash flow. I literally sat down with him and went through his Visa statements for his business Visa. He was buying himself a $5 cup of coffee every morning on the business. If you've ever met Tej Davan, who's my partner in Plains Angels, Tej buys nothing new other than once in a while a car. I mean, for a business, never. Most of the stuff he ever put in his business came off Craigslist, and most of it was free. You want a desk? Find a free one. Don't spend money. Are you nuts? Money's your lifeblood. So you have to have the attitude of, you know, if I walk into a startup and I see brand new iPhone at 10s and MacBook Pros and external monitors, I'm done. I'm done. Because they don't spend wisely. Yeah.
How do you know how much to pay yourself?
Okay, we're going to get to that in a little bit. I'm actually going to talk about that as a founder, and then what you're going to pay for people. We're like a little bit away. So always have your detailed cash flow forecast. The people I knew that were serial entrepreneurs had this spreadsheet on their phones, right? They knew always where they were. And they got updates on cash flow every week from their CFO if they were bigger. They knew every week where they were. It's that critical. Last warning before we go into a model I'm going to show you. Don't fall in love with models. Don't have 10 versions of your model. Don't even have 2 versions of your model. I had an entrepreneur one time that literally spent half his day making variant models. If you're a little bit geeky about numbers, it's really easy to fall in love with what happens if I did this, and if I had this go to market, and what if I did this channel? Do that early on, but pick where you're going and go, and stay focused on the model you want to achieve. Don't get lost. Creating models does not create revenue. Okay, it just doesn't. So I put together some slides. These are all in your book. They're not in the deck up here. So we will go through these real briefly. I just want to show you a few things. You'll notice, if you will turn to the next page, it's at the top it says Report Year 2018. And it says revenue and then sales and marketing on down the side. That's a P&L statement, profit and loss. It's a one-year statement. So for example, if you'll go down the side and find operating expenses, payroll costs in January, it says $2,000. That's the CEO. This is my fictitious company. This guy's got an idea for software tools. And he's made a little money in his life, not a lot, but this is basically his mortgage payment. So he's financing himself. He's given himself enough to make the mortgage payment. I'm not dying more. Pay yourself as the CEO, especially if you're the CEO, as little as possible. I had somebody send me a deck the other day where the CEO was making $150K the first year out, and it was an early stage company. I just no. Not going to happen.
So Mike, I have a question.
Yeah.
So as a CEO or maybe other members of the team, founding team, they decide not to take any
Right.
salary. But then, is that not being less reflective of the value of the company? Because, that's an investment that they're making in the company, but
Right.
that needs to be reflected somewhere.
Well, and you're right. So what you're saying is, where's the investment reflected? This CEO, early stage, probably owns 60% of the company. It's their equity. You're working almost for free to build the value of your equity. Okay? So now, let's say that I'm that person and I'm taking $2K a month just to pay my bills, and you're my developer. Okay? The reality is, unless you're my partner full in, I got to pay you a developer's salary. Brian, what's a developer make these days in Des Moines? A good developer that's 5 years of experience and can build SaaS.
80 to 120.
80 to 120. I got a budget somewhere between 80 and 120,000. Now I may be able to get them in the 80 range if I give them some stock options in the company or give them a piece of the company up front, but I'm going to be the lowest paid person for a long time. If you look along that line, you'll notice that the payroll costs go up to $5,000 a month in August. That's because we added a person. So I'm seeing this flat line in my operating expenses. It means that me as a CEO is doing every job that isn't in sales and marketing or in development, but I'm adding that person. And you'll notice that every time I add a person, I add some hardware costs down in equipment. Those are the kinds of things we look for. If you added the developer, I ought to see $2,500 for the equipment because you got to buy them a machine, right? Most likely you're going to buy them a nicer machine. And if it's a customer support person, I'm going to add $800 or $500 because I'm going to buy them a cheap machine. So the model, and I don't want you to try to go through all of this as a fictitious company, but I just want to point out a few things to you. Obviously, the R&D is where all the money's being spent. You'll see in this budget, if you go up there, that outsourced software line in the R&D is $12,000 a month for the first 6 or 7 months. I'm building my product. And I'm building it with one full-time developer and a bunch of outsourced development. And that number is going to go down over time, and then you'll see in year 2 I actually add a second person in. If you flip over to the next page, you're going to see a cash flow statement. We started our company with $100,000. That was my money as the CEO. I put my own money in. It's pretty common for the CEO or the founders to put their own money in. So I had a starting balance for the company. And the cash flow is just simply saying, how much money do I have at the beginning of the month? How much do I have at the end of the month? That's all it's doing. All right? And you'll notice that in month 2, I raised $500,000. So I had assumed that I could get that money raised and put it in at that time frame. And you can see what the change in cash at the bottom. In March we're down 30,000, April 27,000. That's your burn. That's the money you're burning. When somebody says, "What are you burning?" you can say, "Well, year 1 it looks like I'm burning on average about $28,000 to $30,000." And if you look over to the end in November and December, you'll notice our burn goes down to 12,000 loss and then 13,000 loss. We got some revenue finally coming in, because the first 6 months we have no revenue. Right? We're building. And we're just hoping we can get some revenue going in those first 6 months. If you will flip over to the next 2019 P&L, you're going to notice something between June and July that's really key, because this is where people say, well, how much money do I need to raise? This is a great question. Doing your financial model is a great way to figure out how much money you need to raise. So if you look at the very bottom, at the operating profit line on the 2019 P&L, you'll notice that in June we have minus 1,200, and in July we're at plus 9,000. That's the tipping point. That's the magic. You just went cash flow positive. More money's coming in than went out. And at that point, if you look at your cash balance on your cash flow, so let's flip over to cash flow for 2019, that same June, July, you'll notice that according to this, we started July with $241,000 in cash. So in other words, we burnt through $350,000 getting to just to the point where we broke even. Okay? Now, why didn't we just go raise $350,000 total, 200 from me and 250 from the investors? Because what happens if we miss by a month or 6 months? So this, in my mind, is a pretty safe plan in the sense I've got $250,000 in cash on the books to keep growing and keep paying people, because we're still adding people. We're not just taking profits. We're not reaping. We're reinvesting everything. But as an investor, I'm saying, okay, you're being somewhat conservative, but actually that's pretty smart, because in the business-to-business world, let's say you're selling into the auto industry and the steel tariffs hit tonight. Auto industry is going to have a shockwave go through it. That shockwave could take 6 months to settle down. Okay? You're in the real estate business. Something happens, there's a terrorist attack in London, and the LIBOR rate goes through the roof. And LIBOR, by the way, is like prime rate for the world. And most business loans are tied, they're a floating interest rate tied to the LIBOR. That's what my brother's is in the car business. If my interest rate goes up 3% tomorrow, I'm going to go, whoop, stop, everybody just freeze your spending for a minute. We got to figure this out. So in the business to business world, you have to be able to survive a hiccup of quite a little while. And so without getting too much into it, that magic number down there of when we said our ending cash balance is 241 at the end of June, the beginning of July, that's that tipping point where you can say, okay, I absolutely have to have that much money to get there. Now, how much more do I need to have on my books based on how long is my sales cycle? Is it 3 months? Is it 15 months? What's the average size of a deal? What can one deal do to me? If you have one customer that's half your revenue, you're in a very precarious situation, because if that one customer leaves, you just cut your revenue in half. If your biggest customer is only 10% of your revenue, you're much stronger position. That's just an entry point to this. We were talking about doing a separate class, I kid you not, on doing financial models. We're not going to do it here today. I will make this offer to you. Anybody that's in the room, by Monday I will deliver you a blank template of this model. If you want it, I would ask you to simply email me a note so I can collect them up, because if you just give me your business card, I'll forget. I have a bad memory. But mike@square1dsm.com, and just email me and I'll get you a copy of it. And I will sit down and I'll help you go through it. It's part of what the partnership pays me to do. So please take advantage. And for those of you in the Insurance Accelerator, same thing. I'm here to do this. Don't build your own model if you can absolutely resist it. Please don't spend your precious time writing Excel formulas. Let somebody else do that. Questions on this before we go to the next part?
So who will consume this information?
So who consumes the information? So there's a couple consumers of the information. Your management team. The people that are running this company need to live this every day, every month. You should be reviewing it every month. Where are you at? You should use it as a living document. Your investors will look at this. So this document will give you the numbers you need to put a very high-level picture together. Let's say you want to do a 3-year projection slide of revenues and customer acquisition cost and margin and some of that. Just real simple. That's where those numbers come from. And if I'm your potential investor and you and I go a little deeper, I'm going to say, would you send me a full P&L? And I'm going to expect to see something like this. I'm not going to expect to see your spreadsheet. Don't send your spreadsheet out until much later. But I do expect you to say, here's a PDF of 3 years of P&Ls and 3 years of cash flows. And I expect you to have that available right after the meeting you have with me. Because it'll be my very next question, can you send me your financials? And again, that's a PDF document, but you better have it that day. If your answer is, I'll get it to you in a couple of weeks, I'm starting to get worried. So I'm a consumer. If you're into a more serious, like a seed fund, where there's an actual fund and the professionals running the fund, they're going to want to start with that, and then they're going to see your Excel file. Once they'll sign a non-disclosure and all that, they'll want the file, and they're going to audit it, and they're good at auditing Excel spreadsheets. They're good. They've seen every mistake you can make in a spreadsheet.
So I'm looking for how important it is to show the sheet with some graphs and visuals, because I think, or does it keep it?
Matter of personal opinion. I love hockey stick curves, but everybody's got a hockey stick curve. I'm going to ignore it. I'm a detailed financial person, so by nature, I'm going to ignore every graph you have. I'm going right to the numbers. Most really good investors dive to the numbers. We don't care about graphs and pictures. They're fine if you want them, if that helps you. But I don't think there's really very many legitimate investors that make any kind of decision based on visuals. Again, if you're just trying to show where you've been in the last 3 years, you're raising your A round. Let's say Sharice has got a company and she's raising an A round and she's been killing it. I'd love to show the last 3 years of, I'm right here. This is year to date, right here, and I'm halfway up that crazy curve, and I need $10 million to finish the run to $1 billion. They're gonna be like, yay! But they're still gonna audit our financials at a deep level. They're gonna tear it apart, go through every number and every assumption.
I think graphs come in maybe later, depending on your board structure. So I got to a point where our board, they sat on 10, 15 different companies. There's no way that every month they were going to dig into our financials, but they had like 5 things that they cared about that they wanted to see updated in graphs consistently every single meeting. So I would just say that that probably depends on
Good
who
point.
the audience is. But you want your financials to be easily exported into those types of metrics. I would also say that Mike said, make this usable, because most investors will say, great, you have these wonderful 3-year projections, now show me the last 3 months of the actual numbers within these. So it can't just be this hypothetical document that's all future oriented. Most of the time they want to see how they want to see actuals embedded in this model.
They want to see the trend. Yeah, so the model the model that I give to people to use actually has a tab where you can enter your actuals. And it will actually look and see if there's actuals filled in for a month, and it will use those. So that way, if you're in June and you're still raising money, come on in, Kate. You're in June and you're still raising money, if you've been diligent about it, you have entered every month's actuals. So now you have a 3-year plan that's that's actuals through May, plan June forward, right?